All right. Welcome back, everyone, to a brand new YouTube video. As you guys know, I have not been on it as much recently, but we are back at it. We are back uploading. I'm going to be doing daily uploads from now on. So, again, if you guys want to see more information, more knowledge on what's going to happen, live trading streams, if you guys want giveaways, and if you want a community to get into, please feel free to join the 1% Academy private mentorship at discord.gg/leverage. As you can see from here, we have many trades that are taken throughout the week. I trade every Tuesday through Thursday, so you guys can see where we take the trades when they were called out and our TPs that we hit at those specific times. So we run an MVP channel where we have homework, we have giveaways, we run a bunch of stuff. And as you guys can see, everyone is making money within this server. So if you guys want to be a part of that as well, please feel free to join at discord.gg/leverage. But without further ado, let's go ahead and get into the video. All right, so starting it off here today, we do have market structure. So as you guys saw from the previous episode of our strategy series that we have just began, we talked about what institutional concepts are, the main components of those specific institutional concepts that I use to trade, and then what we can do furthering from there. So now from there, what we're going to do today is we're going to make it a little bit more advanced. We're going to make a breakdown of each part of this series to be able to specify for one specific thing. Today's subject is going to be market structure. So let's go ahead and start off with market structure. All right. So why is it important? What it's going to do is going to help you find direction of an asset for a specific amount of time. So understanding market direction is going to tell you whether price is going to go up or whether price is going to go down for that specific day, week, month, whatever time frame you are using for that case. Now, it also gives you a base perspective on direction. Without market structure, the rest are not valid. So you'll also see me mention supply and demand. You'll see me mention Wyckoff theory as well. But I must point out, without market structure, those are not valid, because what I can see is I can see maybe some type of pattern starting to form. But if I do not understand my market structure, let's say we get a breakout to the upside here, and I'm just saying, oh, it's Wyckoff, it took out some highs, so it should distribute, right? And instead, market structure is showing those bullish higher highs and higher lows. So instead, I should have been looking for those longs, right? And that can help you in those situations to be able to figure out direction and then use everything else to get that trade and then take it to that specific take profit. Next question. Can it be used on its own? Now, the short answer is just going to be no, it can't. And the reasoning for that is due to the fact that you must have more confluence to trigger an entry. Remember, more confluence equals more probability. More probability equals more conviction. More conviction equals more profits over time, right? So we must have more confluence to trigger our entry. If we're just sitting there saying, oh, the market is making higher highs and higher lows, so I'm going to grab a higher low right here, and then you look to grab it, and then it ends up liquidating you and continuing to the downside, there will be other triggers that will say, hey, you know what? Maybe it's not just market structure, right? This can be easily manipulated from a retail perspective. So instead, what we should do is we should use it to figure out our structure, and then come time, let's say here comes 9:30 a.m. and it's a break of structure to the downside after taking out maybe a previous session high. And what that's going to show is that creation of then supply versus demand on these lower areas. So we can get into that supply and we can take it lower to the downside. So it cannot be used on its own. Do not look to try to use any of these concepts just by themselves. Instead, we must pair them together to allow for more confluence. More confluence, again, is going to allow for more conviction, which will mean more confidence and comfortability for you as a trader at the end of the day. So now, last question. Last question being, when should you implement it? When should you use that concept to be able to get into a specific trade? Now, every single time you open the charts to trade / analyze, and we'll also talk about top-down analysis. So what this specific video is going to be is just more of a definition and understanding of how market structure works. We're going to show some simplified examples, and then we will have a part 2 that will show actual examples from actual trades taken in the actual server. So what we'll do is we'll go over that, but let's go ahead and start off with understanding what market structure is in the first place and how you guys can read the charts from the same outlook. All right, so the market will always be in two different types of trends. You will either have a downtrend overall where price is moving to the downside, price is creating lower lows, or you will have an uptrend where price is moving to the upside. For a downtrend specific scenario, you will have what is called lower lows and lower highs. So a lower low is going to be marked down here. A lower high is going to come up and create a high that was lower than the previous high. So this was a lower low as it was under the previous low, and this is a lower high as it was under the previous high. So our job as institutional traders is going to be to catch that next lower high to be able to take it into that next lower low to be able to catch our overall trend. Now for an uptrend, you will have what is called higher lows and higher highs. For higher highs, this will be the same exact thing as we talked about over here, but on the opposite spectrum. So we have a high that was past the previous high. We have a higher low. We have a new high, a higher high as it created a high over this one. And then we have a higher low as it was a high over this one. So our job again is going to now be to catch the higher low for that continuation to catch it to the upside into that next high. Now let's go ahead and talk about weak highs, weak lows, strong highs, and strong lows, what they mean and how we can use them. All right, so now moving on to strong highs, and weak lows and weak highs. Let's go ahead and talk about what these mean. So a strong high is going to be a high or a low that caused a new high or a low. So in a specific situation to where you have a reversal, right? You're making lower highs, lower lows, lower highs, lower lows. Now you have a higher high that is caused. This low now becomes a strong low versus a weak low where we could have seen price seek into that low. Now it is a strong low, so we can expect price to hold that low and continue to the upside. So that's what a strong low would look like. Those are going to be those protected lows. Now we get another new high that is sponsored here. So this is your next strong low. Price should not come through this low unless it is ready to reverse. So this keeps it simple as far as finding out which spot you are in to be able to catch that long or that short trade and hold it thoroughly. So strongs will be protected. Price will not break until a reversal is ready. So let's say if you have a situation to where price is making those higher highs and higher lows, you have a strong low that occurs, and then you have price move down, and it ends up breaking that structure point. Now you have an imbalance that's created, and now you have that specific show for a lower high for continuation to the downside to show that reversal versus that strong low being held here. So now let's talk about weak highs and weak lows. All right, so now in a scenario where it is going to be a weak high or a weak low, this would be a high or a low that did not sponsor a new one. So if you have a situation where price is in a downtrend, creating those lower highs and lower lows, lower high, lower low, lower high, lower low, we will look for that next weak low as that target. So once price comes up and creates this lower high right here, you now have this lower low, which is going to be a weak low because it did not cause a new high. So therefore, we can get into that trade, look for that trade to the downside, catch that trade, and take it into that weak low, which is right here. So your strong lows and strong highs, those are going to be what you look for price to hold and protect and continue in a given direction. Weak highs and weak lows are going to be more of targets and areas of liquidity for price to continue its given direction, moving into that liquidity as it goes. Now, let's show some examples of this with the charts, and then we will talk about actual top-down analysis, how you guys can do the same exact thing. And then in our part 2 of the advanced market structure series, which we will be starting right after today's, this will help you guys out with actual examples of trades taken, how you guys can do the same. We'll go over with replay mode to show you guys everything as it is happening and how you guys will be able to do the same exact thing. So now let's move on to that top-down analysis for how market structure works. All right, now going over top-down analysis. What is top-down analysis? How can we use it to find our directional bias? And what will this look like in a real-world example? Now, top-down analysis is going to be using all of your time frames to find a directional bias. Again, more confluence equals more conviction. More conviction will equal more profits in the long term, right? So using all those time frames to find that directional bias, we must understand this is the most important thing, that higher time frames are going to be the moral of the story. So they will tell you where price wants to go overall. If the higher time frames are bullish, but the lower time frames are bearish, all we have to do is wait for those lower time frames to then switch to bullish, and that will allow us to get in that specific trade and take it to that higher time frame tell. So your higher time frames are going to be your weekly, your daily, and your 4-hour chart. These is what I use on my higher time frames to be able to figure out where price is going to go on a higher time frame bias. And then your lower time frames are going to be your hourly, M15, M5, and M1. These will be mainly my executions. I mainly personally execute on the M5 and the M1. So after I figure out, let's say, hey, my 4-hour is bullish, my hourly is also bullish, my M15 is bullish, but M5 is bearish. I will wait for that M5 to switch within a specific allotted time. I like to trade at 9:30 in the morning for New York session, and then we will get into that trade for the M5 or the M1 and take it to an either hourly target or an H4 target overall. So using this top-down analysis is going to help you very, very, very much as far as figuring out your direction. So let's go over an example of this, and then we'll talk about an example with candlesticks as well. So now using an example, let's pretend that this red line here is going to be our 4-hour chart. So these are 4-hour candlesticks. This is a 4-hour downtrend that we are currently in, where we are creating those lower lows, lower highs, lower lows, and lower highs, right? So we have a lower low here. Here comes another lower high. When using top-down analysis, what you can do to figure out when you actually have a lower high or a lower low in place is what you'll do is you'll see your next time frame structure. So at this point in time, as price is moving up to a previous area of 4-hour supply, you'll have hourly bullish structures. So let's make this red. I'll make this a different color in just a second here. But as price is moving up, it is creating those higher highs and those higher lows. We'll do this in a purple. So purple is going to be our 1-hour directional bias in this case. What we can do from here now is figure out where price is going to break that structure point from those higher highs and higher lows on a lower time frame to then switch with the higher time frame overall and use that to figure out our directional bias. So once that breaks structure, we now get that lower low. Remember, strong low that caused a new high that has been broken. Now we have a strong high that is in place on the hourly as well as the 4-hour already being bearish. So we can look for that area of supply to continue to take price to the downside. So instead of us looking for this entire H4 area of supply using this as our stop loss, we can use just this lower time frame instead, where we get another area of supply right here. Price comes up into that high. We catch that area of supply. We have a much better risk to reward ratio from a 6-to-1 versus like a 1-to-1 here. Let's say if we were to enter on this, try to take it to this low. Yeah, see, with a stop like that, you're looking at a 1-to-1 versus a 6-to-1 just by waiting for that lower time frame to switch. Now you can look for the same exact things as well. So let's say you get this 15-minute break of structure to the downside. Your 5-minute will do the same exact thing it just did on the hourly, break structure to the downside, and then you have an even more increased R&R available because of that. So top-down analysis is very, very important to figuring out that. Now let's talk about a situation of a reversal and how you can use top-down analysis to figure that out as well. All right, now for a reversal situation, this will be very similar to a continuation, but all you will have to do is figure out when you will create that next higher low in this situation. So we are in a downtrend. As you guys can see, price is moving to the downside. We're creating those lower highs and lower lows, lower highs, lower lows, lower highs, lower lows, lower high, lower low, and then here comes that break of structure, right? We get that higher high. But how can we confirm this as a break of structure and not just a liquidity sweep? We'll go over liquidity sweeps later in this series, but we're just going over market structure right now. So with market structure, to be able to figure this out now, if purple was my 4-hour chart, we would go on the 1-hour, watch price. If it is creating that downtrend, we will watch it as it comes back into that area of demand. And then once it comes to that area of demand, if it breaks structure again on the hourly, now we have that higher low that is in place to catch that continuation to the upside. So if I make this red, you guys can see that 4-hour chart versus that 1-hour chart, right? You'll have those basically structures within structure. And what that will allow you to do is figure out when you will actually have that higher low in place. So if price does not do this on the hourly and instead it just keeps breaking down to the downside, then you have a liquidity sweep and you can take it into now this low here versus price creating that reversal, breaking structure to the upside. You now have that area of demand to catch that reversal trade and take it higher into areas of premium. So this is why top-down analysis is very, very important. And what I show you guys, the way I showed it to you, from the 4 hour to the 1 hour, the 1 hour to the M15, this can be applied in both situations. Meaning, if this was my 4 hour and 1 hour chart right here, this could be an hourly chart and a 15-minute chart. This could be a 15-minute chart and a 5-minute chart. You will see the same things over and over and over again, which means that price is fractal. So you'll see the same behavior from higher time frames to lower time frames, no matter how many you switch, right? It will be the same thing over and over again. Now, from that, let's go on to some real world examples, as well as how you guys can get into some trades as well. And then we will end it for today. We'll get on to some advanced market structure series tomorrow, and I'm very, very excited to be dropping these for you guys. Again, if you wanted to join the 1% Academy Discord server, please feel free to grab the link in the description. It is a private server. It is also paid, but you guys will be able to see the prices up on the server, as well as we run giveaways every month, every other week almost, so you guys will be able to see in there and may be able to even get in from there. So again, if you guys wanted to check that out, feel free to go check that out. And if you guys found some value in this video, please feel free to like and subscribe. I will catch you guys on the next one, but for now, let's go ahead and do our real world examples, and then we'll jump into the next one. All right, so moving on to a real world example now. This was actually with a trade taken on the previous Friday. We can see that was taken on Friday right here. It was a long trade. I took it up into this high right here. But let's talk about why I took this specific trade, right? On higher time frames, doing top-down analysis, again, we're just going to use market structure at this point. But on higher time frames, we have a break of structure to the upside right here, right? Price comes up, it creates that higher high, and now starts to move lower into the previous area of demand that caused that new high. So as it starts to do that, now what do we do? Again, we literally just showed this example just before this, but we look for those lower time frames to switch. So if my hourly chart, which if we go on the hourly, you guys can see that it is bullish at this point in time. We got that bullish break of structure to the upside. So if we're on our hourly chart, we could see that price is creating higher highs and higher lows. Now, if I go to my M15 or my 15-minute chart, all we have to do is wait for that switch, right? That switch to occur. And you guys can see that as price is coming down, creating lower highs, lower lows, lower low, lower high, lower low, higher high, higher low, right? And that's where you can see that I actually caught that entry and then took it up into just this lower time frame area of liquidity right here, right? But this is that same exact example of price creating the higher high. Here it comes. We have to confirm the higher low now. If we go into even lower time frames, you guys can see where that switch happens, where price comes up, creates a higher high, higher low, higher high, higher low, break a structure to the upside right here. That's where I ended up catching that trade and taking it into that high that we can see. So if I remove all of this real quick to make it clear for you guys, we can see again, if we're following our structure at this point in time, it breaks structure when it creates this higher low here. So we come down, lower high, lower low, higher high, right? That's where we get that break of structure. Area of demand is now in, and it starts to move up into those highs that we can see right there. So that's what we're going to look for every single time. It's just a break of structure on a higher time frame and then a lower time frame confirmation that will allow you guys to comfortably get into trades, as well as comfortably analyze and find that directional bias in the market every single day that you guys look to trade. I trade Tuesdays through Thursdays, so every single day, this is what I'm doing every single time. I wake up, right? I get to my charts, I do my top-down analysis, I figure out my areas of supply and demand, I take my trade, and then I am done for the day. All right, if you have made it to the end of the video, very, very proud of you. Again, patience is one of the hardest things in this world and for ourselves as humans to be able to conquer. But once we can conquer patience and understand that, this will be a game that you can sustain yourself for life for, right, with trading. So if you guys were able to show the patience of sitting till the end of this video, you have the patience to trade. So keep it up. I love to see the work. If you guys wanted some more EDU, you guys can check out my YouTube page. I have a bunch of series that I do all the time. You guys can check out reviews. You guys can check out a bunch of things that I have up on there for that. If you guys wanted to join the 1% Academy private mentorship, again, the link will be in the description, or you can just go to discord.gg/leverage, and that will allow you to get the invite to be able to get in. You'll be able to see prices. You'll be able to join the giveaways, and we can get started from there. There's live trading, community, giveaways, a bunch of stuff that we have going on all the time. And again, this was only a part 1, so I will catch you guys on the part 2 for the next video. We will go over more more real world examples, as well as maybe some live trades as well that I have taken to allow you guys to be able to get into the same exact scenarios and start to understand this more. If you found value, please drop a like and subscribe if you guys want to see more, and I will catch you guys on the next one. Peace out, everybody. Have a great rest of your day.